So today's topic is foreign currency risk. Now, what is this foreign currency risk? Let us understand what is foreign currency risk. See, let us start with a very simple and layman kind of example. You have stepped out of your house and you want to purchase an apple. So you go to a vendor and ask, what is the cost of this apple? The vendor says, sir, it is 30 rupees. That means one apple can be exchanged in terms of money, currency, that is rupee. You are paying 30 rupees for one single unit or piece of apple. This shows the exchange rate for apple in India is rupee, Indian rupee. So in India, you can buy anything with Indian rupee. The standard medium of exchange is rupees in India, right? Point number one, because it is the legal tender in India. Yes. Now, as apple can be bought in terms of rupee, you are not giving gold, silver, you're not giving them guava to, take one apple. You're not exchanging a fruit with a fruit. You're not exchanging gold with a fruit. You're not exchanging silver with a fruit. You're exchanging currency with a fruit. This currency, India's currency. Okay. In India, India's currency works. Imagine you want to go to United States of America. If you want to go to United States of America, if you carry your rupees with you, bundle of rupees, you can't buy anything in US because rupee is not a legal tender in US. You want dollars. So now what will you do? Of course, we will approach a bank. We'll ask them, see, I want to go to US. I want the US currency for that because Indian currency doesn't work there. So bank will say, sure, no problem. You can come with rupee and you come prepared with 90 rupees. You come prepared with 90 rupees, I will give you $1. So this creates a exchange rate that shows, yes, in reality, you can buy money of other country with money of your country. That means United States of America's currency can be bought or purchased with Indian currency. Purchased or what? Exchanged. That means he will give you $1. You will give him 190 rupees. So he will give you $1 and you will give him 90 rupees. In this way, we understand one thing. As apple can be exchanged with rupees, dollar can also be exchanged with rupees. Very clear understanding, very clear, simple way of understanding this. Apple can be purchased with rupee, like this is a commodity for us. Dollar can be exchanged with rupee. This is also like a investment commodity, whatever for us. Okay, currency for us. There are forex markets where the trading happens for 24 hours in a day. 24 hours trading happens, yes, in forex markets. Forex, like, dollar futures, dollar options. People, trade in them. Okay. Now, as we know that $1 can be purchased with 90 rupees, you'll have a dilemma. You'll have a kind of question in your mind, sir, I purchased one apple for 1 rupee for 30 rupees. Why didn't I purchase one apple for 1 rupee? See, market forces will derive the price of apple, not you. So you'll have a dilemma, right? Sir, one apple, when I went to purchase, I paid 30 rupees. Why not 1 rupee? 1 rupee, one apple. You are not going to decide the price of apple, the market forces. How much it costed for them to grow this apple? What conditions they grew this apple? What fertilizers they used? What was their costing? Climatic conditions, transportation charges, storage charges, everything adds up. In the same way, you will have again a question, sir, why I'm not able to purchase $1 for 1 rupee? Not possible. Market forces will decide the price of $1 with in exchange to your currency. That means uh, if you want to buy dollar is a global currency. It's the strongest currency in the world. Of course, one of the strong because it's a major economy, and India buys lot of oil from Gulf countries. So India has to pay payment in dollars. The billing, India purchased billions of dollars. That means lot of oil is purchased from Arab countries. And everyone has made an agreement and pact that all that will be only traded in dollar. So dollar is always in constant demand. India's rupees demand will only increase if India's currency demand will be very high in the world. When will that be high? When all countries would purchase Indian products. That means they will be fully dependent on Indian products. That day our rupee will also start appreciating. But for that it will take a lot of time. And when India got independent, $1 was almost equal to equivalent to rupee. But slowly, steadily, what happened? India's dependency started growing. India, as dollar, they made an arrangement that everywhere in the world, if you want to do trade, you can do only in dollars. And major trade of India happens wherever India trades, India has to keep dollars reserve currency. Why? Because if the India wants to import anything from other countries, India have to pay in dollars. And if India sells anything, India will accept in dollars. They will give dollars that will be converted to rupee. That's okay. And if any XYZ African country wants to pay in their currency, India won't accept because that currency is not a global currency that doesn't trade anywhere in the world. Only Indians, if they want to go to that African country, then only that country's currency will be, in demand for Indians. But I don't want to name a country. Let's say any country in Africa, you take any XYZ country. What importance that country has for India? They only export goods from India, but India rarely imports anything. So if India accepts their currency, like if India, does trade with all the countries in their currency, India has to maintain Vostro account. India have to open their branches. Their branches will open here. And, Indians won't go often to those countries. India's trade relations with those countries is limited. Doesn't make sense. And those countries' currency, if India take even, those are not anywhere traded. Okay, only with that country. But dollar, anywhere in the world, India wants to have a trade relation. Dollar can be, paid and received. So dollar is a global currency. We can conclude our topic till here. Okay. Now let's go for next point. What are we going to study? Risk. What now we have understood that $1 can be purchased for 90 rupees, as one apple can be purchased for 30 rupees. Now, sir, market forces have decided how much one apple should cost, how much $1 should cost. We are a part of market. We know like market forces, they study the economy, they study the demand, they study the supply, they see everything and they decide. So, sir, then what is this foreign currency risk? First of all, what is risk? Risk is future probable adverse events which can create losses to us. So in future, certain events which are not favorable, that means which are adverse, and they can create losses to us. So what is the problem there? See, if some adverse events happen, which are probable, that means there are likely chances that those adverse events will happen, and they can create losses to us. If they create losses to us, then what? They are nothing but risk. For example, you purchase stock of ABC company. They promised you returns of 12%. If the stock gives you 15% returns, yes, this is also possible. You will be very happy. See, first of all, when you purchase ABC company stock, you took a greater risk. Why? Because you have taken only one company's stock. You did not diversify. So if this company goes into losses, then definitely you have to incur big loss. But fortunately, it has gone up. It is giving you 3% additional returns. You are happy. But this was not what I explained you. Market for like 15% is good return, but I said future probable adverse events which can create losses. What happened is someone in this company has done some fraud. Because of that, the stock prices fell and the returns also fell to 7%. Now here there is a 5% loss to you. So I was speaking about this factor, not about this factor. So future probable adverse event. See, some adverse event has happened in ABC company. Some manager has done some fraud, scam, because of which like people panic selling started and the prices fell, and they are not getting enough capital to expand the business, etc. So their business is also going into losses, and this loss is a adverse event. So we always want to minimize these losses. So what we can do, we can diversify. We suddenly realized that we did a mistake by investing in one single company. We would have invested in five different companies. So if ABC would have gone into losses, no problem. Other companies would have performed well, and these losses would have been absorbed or balanced. But we didn't do that. That is what a mistake we did. So that's what we know, that risk can be this risk can have a negative impact on our income, on our earnings, etc. So we need to make sure that we always try to minimize it. And one more thing, risk is always associated with any activity we do. We cannot, we cannot remove that from any activity. We cannot remove that out of our lives. We are always exposed to some or the other risk. Okay. Now, we will just try to relate the topic with that Apple example. Now I spoke about risk, right? I'll take one Apple. So when I went to the vendor today, he quoted me 30 rupees. Now what risk can I have with respect to this Apple is the price changes in Apple. Like if today Apple is available for 30 rupees, tomorrow the Apple may not be available for 30 rupees. Let's say the Apple may go to 40 rupees. So next day I end up paying how much extra? 10 rupees. This is a risk for me, transaction risk. Apple prices not being stable and always dependent on market forces. The risk for us is we may end up paying more for one single Apple. That is the risk what we have. And if it goes to 25, we are very happy. So what? First we are understanding about the risk, then we'll understand about the remedies. Okay. So what was this risk? Transaction risk. The Apple price is increasing, we end up paying more. Okay. Now, in case of dollar, also the point is same. After 6 months, future, we can't predict the future, right? Today on spot, you are ready to pay 30 rupees for one Apple. You are okay with that. You have no problems because that's the spot rate. Not only you, the entire market will pay 30 rupees with whatsoever bargain they are selling at fixed price. If you get a better deal with bulk purchase, then that's a different matter. But they are only willing to sell at this. Now, $1. Okay, I just now we discussed $1. I want to buy today. It is available for 90. Now, my concern, there are two things I'm concerned with. If I want to go to US for a visit after 6 months, after 6 months, if $1 becomes 100, I have to pay 10 rupees more for that. That is my concern. That means dollar becomes costly and 90 rupees now can't buy $1. My currency's purchasing power has gone down due to any of the factors like inflation. If there is more inflation in a country, that country's purchasing power will decline. So now I end up paying 10 rupees more for dollar. That is one of the transaction risk. Yes, this is when I buy the dollar, when I buy. So the buying rate of the dollar has increased by 10 rupees. Buying rate is high. Now, if someone, let's say in future, has to pay me $1, today the exchange rate is 90 rupees. Okay. Someone has to see here, I have to buy a dollar. So today, if I buy 90, after 6 months, the dollar rate has gone to 100. I'm paying 10 extra. Someone has to pay me dollar. If today they pay, it's $1 is 90. If they pay after 6 months, and if $1 becomes 80, then I lose 10 rupees. So in these both cases, I have a risk. If I have some international transactions, or I'm involved in export import business, or I give some services to people in US, I charge for that. I have risk every point of time. What is the risk? The currency rates, $1 is equal to 90 is not stable always. Either $1 can go to 100, $1 can go to 80. So what happens if 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 let's say in future I buy dollars and pay 100, I'm losing 10 extra. If in future I sell dollars to the bank, okay, and convert that into rupees, if I get only 80, I lose 10 there. I'm again telling you, if I buy for 100, I pay 10 extra. If I sell for 80, I get 10 less. So here also I am into loss, here also I am into loss. So first we are understanding about the risk factor. Then we will see the remedies. Don't worry. Now I'll give you a very simple example. This is me who is giving some tuition classes in US. Today $1 is 90, but the student says we will pay you after 6 months. They gave me bank guarantees and all. Fine, okay. $1,000 is what? Okay, I'll just put it $100. $100 is what the fees is. Okay. So today itself, if because this fees is a asset for me, it's a receivable. You should understand, never ever your asset value should decrease. If your asset value decreases, it's a loss for you. If your liability value increases, it's a loss for you. It's a two-way loss. So if today spot rate is $1.90. If today $100 is exchanged for 90 rupees, $1 is 90, so $100 will be how much? 9,000 rupees. Yes or no? So today I get 9,000. But the person has agreed to pay me after 6 months. After 6 months, $1 becomes 80 rupees. What does it mean? It means the rupee has, or I can say, previously 90 rupees was, you know, enough to buy $1. Now 80 rupees is enough to buy $1. 10 rupees less I'm paying. That means the purchasing power of rupee has increased. I took 90 rupees with me, but bank said keep your 10 rupees with you and only pay me 80 rupees. What does it mean? It means I'm paying lesser rupees or less units of rupee to buy 1 unit of dollar. So dollar has depreciated. If my foreign assets value depreciate, it's a loss for me. How? See, today if the payment was made $1.90, so $100, 9,000. After 6 months, $1 is 80. If I exchange $100, 8,000. So I get how much less? 1,000. This 1,000 is loss for me. Why it's a loss? Because dollar depreciated. My assets value has gone down. If my receivables or my dollar assets were worthy how much previously in Indian, like in Indian currency 9,000. Now my dollar assets are how much? 8,000. So there's a loss. Yes or no? Dollar depreciate, rupee appreciate. Not good for foreign receipts. Saying from India's perspective. Not good. Okay. Case number 2. $1 is equal to 90. And today if I pay $100 to someone, payables. So 100 into 90, I pay 9,000. After 6 months, $1 is equal to 100. See, if $1 is 80, it's good for me. Now I have to pay them $100, right? To pay $100, I have to buy dollar. Today's buying rate. See, now again I'll tell you one thing. Here, if today I see the exchange rate 90, in future $1 is 80. So when the person from US will pay me $100, I will go to bank. See, today if he would have paid me $100, I would have gone to bank and got 9,000. After 6 months, when he pays me $100, I'll go to bank and I'll get 8,000. So here I sold dollar because I'm receiving dollar. It's a receivable for me, dollar assets. I'm getting dollar from US. So I'll exchange that with bank. Okay, that how will I exchange? I will sell that to bank. So previous, if I would have sold previously, I would have got 9,000. Today I'm getting 8 after 6 months. So 1,000 loss. When I need to pay to someone who is in US, I need to buy dollars. Today, if I would have bought dollars, it was costing me 90. After 6 months, it is costing me 100. So I'm ending up paying 1,000 more. So this is a loss. So what does it mean? It means here your liability, here it is a payable, right? Liability is increasing because your foreign liability value is increasing. There, when you were supposed to receive dollar assets, dollar were your assets, and if assets value fall, it's a loss for you. If liabilities value increase, it's a loss for you. So liability, foreign liability value is increasing. How? Because the dollar has appreciated here. Why dollar has appreciated? Previously, you are paying 90 rupees for $1. Now you are paying 100 rupees for $1. That means you are paying 10 rupees extra for 1 unit of foreign currency. When you end up paying more for your, when you pay extra 10 rupees of your currency to buy $1, the purchasing power of your currency has gone down. Okay. That means more units of currency you are paying to buy $1. Dollar has appreciated, rupee has depreciated. So that's what. Okay. So whenever there is a foreign receipt, receivables, this is your dollar asset. Okay. Let's say you are supposed to receive for $100. Dollar should appreciate, then gains. Okay. How? If $1 was 90 and $1 has gone to 80, there was a loss. Dollar should appreciate, gain. If dollar depreciates, loss. Because this is a foreign asset for you. Foreign asset value decreases, loss. In the same way, foreign payables. Now, today $1 is 90. If it goes to 100, we are paying extra. So dollar should depreciate, then gain. If dollar appreciates, loss. Foreign liability should foreign assets decrease, loss. So foreign liability increases, loss. So if let's say instead of 100, if $1 was 80, so we would have paid 80,000. There was a gain for us. Okay, or 8,000. There was, sorry, not 80, 8,000. 8,000. There was 1,000 rupees gain for us. But here the value has increased. Liability value has increased. So today we conclude our session with this. Now tomorrow we will be solving some activities. We'll go for transaction risk. We'll solve some activities and I'll explain you two-way code also. Okay. So introduction was like whatever introduction we did,